Okay, let's talk about two major headlines today. The devastating fires in LA that destroyed over 10,000 homes and the 10-year Treasury hitting 4.75. Now, at first glance, these might seem unrelated, but they're deeply connected and both have significant implications for the housing market, inventory, and your wallet. So let's break it down. First, the unfortunate LA fires. Over 10,000 homes have just disappeared. California has one of the most severe housing inventory shortages in the country already to begin with. Builders can't keep up with the demand, and zoning laws and labor shortages have made it nearly impossible to scale housing productions. Now, add to that this massive loss of inventory in Los Angeles. What does that mean? For one, the demand in housing in surrounding areas is about to skyrocket. People displaced by the fires will be looking for rentals or temporary housing, putting even more pressure on an already strained market. If you're a landlord in LA or nearby, you're likely to see rents climb as competition increases. Now that sounds sad, but it's a sad reality. But this isn't just about rentals. It's also about long-term impact on home buyers. California has a huge backlog of millions of units that need to be built just to keep up with the population. And now with these 10,000 homes out of the picture, that backlog grows even larger. Builders are going to be forced to prioritize rebuilding fire-damaged properties over starting new projects. That means fewer new homes coming online in the near term. The inventory crunch, which is already driving prices up, is about to get even tighter. For anyone waiting on the sidelines, hoping for home prices to come down, this is another reminder that waiting might not be the best strategy. Now, let's connect this to the broader economy and today's 10-year Treasury hitting over 4.75. Why does that matter? Well, the 10-year Treasury yield is the benchmark for mortgage rates. When the yield goes up, mortgage rates follow right behind. Right now, we're seeing 30-year fixed-rate mortgages inching closer to about 8%. If you're in the market to buy, this creates a double squeeze: higher home prices due to limited inventory and higher borrowing costs due to rising rates. And here's where it gets really interesting. The Federal Reserve has been using higher interest rates to cool inflation, but the housing market, it's not cooling, it's stuck. Builders can't build fast enough, and people who locked into 3% mortgage rates during the pandemic aren't selling. What does that mean? Inventory is going to stay low, prices are going to stay high, and buyers are going to be stuck with higher borrowing costs. This creates what I call a housing bottleneck, where the market can't move forward and affordability simply keeps getting worse. So what should you do about it? First, if you're the buyer, the key is to focus on what you can control. Look into creative financing options like temporary rate buydowns or adjustable rate mortgages to offset some of the upfront costs of the higher rates. Remember, rates are temporary. You can refinance when they come down. What's permanent is owning an asset that appreciates over time. Waiting for prices or rates to drop might leave you behind as inventory continues to shrink. Now, if you're an investor, this is a critical moment to take advantage of. Opportunities in the rental market and anywhere else, okay? With displaced renters from Los Angeles looking for homes, rents are going to be climbing, especially in neighboring areas. This could be a great time to lock in an investment property if the numbers make sense. And don't forget about programs like Section 8, which provides guaranteed rent payments from the government and can stabilize cash flow in uncertain times. For builders and developers, the fires in LA are a wake-up call. The focus will need to shift towards rebuilding efforts, but there's also an opportunity to advocate for zoning reforms and incentives to make it easier to build at scale. California's housing crisis is not going away, and events like this only highlight the urgency of addressing it. Finally, let's look at the bigger economic picture. The 10-year Treasury hitting 4.75 signals that investors expect rates to stay higher for longer. This means there's slower economic growth and increased pressure on households as borrowing costs rise. But remember, real estate has historically been one of the most stable investments during times of economic uncertainty. Owning a property gives you a hedge against inflation and a tangible asset that can generate income. So, whether you're a buyer or an investor or someone trying to make sense of the market, the message is the same. Don't let the headlines scare you into inaction. Use this moment to educate yourself, explore your options, and make moves that align with your long-term goals. If you got questions about how to navigate this market or you want to run the numbers on a deal, drop a comment below or reach out to me. I'm here to help you. Remember, the best time to start is right now.